Now, investors oversubscribed the government's bond auction for the month of June, held yesterday, bidding for 66.7 billion naira compared to 60 billion naira that was offered. Steve Oshaw, co-managing partner and head of advisory at Commercial Partners, joins me now in the studio to review activities in Nigeria's fixed income space in the first half of the year and also what investors can expect for the second half. Steve, thank you so much. Pleasure to have you on the show today.
Good morning.
Now, I think the trend that we saw, that one trend that we saw in the first half was that broad decline in yields, across the board. Of course, that was on the back of the federal government's plan to just reduce its participation in the debt market. But I'd like to hear your perspective in terms of how that actually impacted on the market.
I think we've actually had a very good first and second quarter of the year. If you look at the way the yield curve actually trended from January till now, even though it looks like we're gradually moving to how we started at the beginning of the year in January, if you look at the bond yield curve. But generally, I think if you look at how we fared between March and June, you agree with me that interest rate has come down relatively low. Exchange rate has remained relatively stable. Inflation has moderated from the high of 13.3 around March till about 11.61, the last one. And generally, I think it's been a good time. Although if you look at how much has been offered and the level of subscription we're getting, especially on the yield on bond, it looks like we're actually, the yields are getting weaker compared to where we were like 2 months ago.
But while all of that was happening, we know that the CBN at some point wanted to try to get yields a little higher. Would you say that the CBN was able to succeed in doing that?
Well,
just to keep the FPIs here.
If you look at the short end of the curve, say for 1 year paper and the heavy subscription, the heavy flow we've actually gotten on OMO, you say they've actually tried a bit. I think there was a time that actually we got to around 11 or sub 10 when it comes to 182 days to 270 days paper. But now they're trading as high as 12%, even though they're still low, but again, higher than what it was a little while ago, especially when we have the pressure on the FX side. I think relatively interest rates have been kept low, and that will probably just determine how this is actually shaped going forward. But again, I think there's still some inherent risk in terms of the pressure on FX and slow demand coming from PFAs and offshore investors.
Now, while all of that was happening, those are mostly domestic issues. On outside our shows, we had the U.S. Fed increasing rates, and we're told that we should expect at least 2 more for the rest of the year. So obviously, fund managers, are beginning to reprice risk, reprice assets, especially in emerging frontier markets like Nigeria. So I'm thinking, going into let's talk about second half now. How do you see that shaping our markets for the second half of the year?
I think, like I said, it's obvious now that the Fed hike has actually affected the market somehow. Like I said earlier, in April, some of the 5, 7 year and 10 year papers printed around 1280 to about 13 levels, just below 13 levels. The last one printed at 13.5, and now we're talking around 13.85, 13.89 levels. So I think that's already affecting the market. We're having weak demand coming from offshore investors, especially the FPI. We're having weak demand coming from the PFAs, who are mostly heavy on bond.
Why is there weak demand from these?
Well, I think the multi-fund structure that was just introduced by PENCOM is having some bearing in that. Some of them actually may be full on the limit that they could have on government securities, and they're slowing down on that. And
now they have to allocate more to the equities market.
Exactly, yeah. So they have to allocate more to some other alternative class of assets. I think that is slowing down. So most of them that are having maturity are actually looking for other form of investment that they can put their money on. And the banks are not actually heavy on the long durations, really.
Shouldn't
so most of them are actually playing on the short.
I'm just thinking, because of that converse relationship. So how high do you think, if that persists, I'm thinking how high do you think that could shoot yields?
I think, like I said, I think we're back to how we started at the beginning of the year, at the region of around 14%. I think there's still some room for uptick in yield. probably maybe around 14 or slightly above that level for the rest of the year.
So I'm thinking, I mean, that's just that negatively impacts on the federal government's plans to, I mean, doesn't it, to reduce its participation in the market, and of course it has wider implications for debt service, which is at the heart of that strategy. That's
actually huge, and if you look at the fact that they're actually looking to borrow more on the international market.
I was going to talk about that now.
Yeah, so it's going to have some impact in terms of debt servicing, and if you look at the debt right now, I think we are standing about 22.7 trillion. Local debt stands about 15.6, if I'm not mistaken. So it means that we're actually increasing the amounts we're actually borrowing out there. We've seen an increase of about 4.5 from where we were last year till now. So it's the same story. Well,
one thing is certain, we must borrow. Governments everywhere borrow. But let's talk about the latest announcement from the DMO, $2.8 billion in foreign borrowing to fund the 2018 budgets. But what's crossing my mind now is that with the hike in interest rates and the normalization of monetary policy in developed markets, especially in the EU and the UK, do you think that this time investors are going to demand a higher premium compared to what we did from our last outing?
I think it's obvious. The risk is there, and that's the reason why we are not seeing so much of demand in our local space. And if you look at the way the international market has traded, the yield curve actually moved from the region of 7% levels, especially for the FGN sovereign bond that we raised last time, to around 8% levels right now. So if we are raising money from the international market now, although the demand for Nigeria or the appetite for Nigeria is still very there.
Regardless.
Yeah, exactly. Especially based on the fact that oil price is still doing well. It's above 70. Reserve is actually robust. So the demand for Nigerian government will still be there, but the fact that the international market is actually pricing what is happening from the Fed space, the hike that has been anticipated, and more to come before the end of the year. So definitely that's going to impact on the outcome of the year.
What about other risk here in Nigeria? I know that they're pricing in the U.S. Fed hike, but what about political risk here for us? I mean, the higher the risk, I'm thinking, I mean, investors might want to demand more to hold on to government debt.
Correct. But like I said, the appetite for Nigeria is still there.
So that's a good thing anyways.
Yeah, it's a good thing.
With the government...
But again, the political risk, we can't just push it aside, so it's still there.
Yeah. Okay. Steve, thank you so much. It's been a pleasure talking to you on the show today. I've been speaking to Steve Osho, co-managing partner and head of advisory at Commercial Partners.